Understanding credit scores, a beginner's guide. What is a credit score? A credit score is a numerical representation of your creditworthiness used by lenders to assess the risk of lending you money. It reflects your credit behavior, including how you've handled debt in the past. The score typically ranges from 300 to 850, with higher scores indicating better credit health. How is a credit score calculated? Credit scores are calculated using various models, with the FICO score and VantageScore being the most common. These models consider several factors from your credit report. 1. Payment history, 35% of FICO score. Consistency in making on-time payments. Accounts with late or missed payments. 2. The amounts owed, 30% of FICO score. Total amount of debt. Credit utilization ratio, the percentage of your credit limit that you're using. 3. Length of credit history, 15% of FICO score. Age of your oldest and newest accounts. Average age of all your accounts. 4. Credit mix, 10% of FICO score. Types of credit accounts, credit cards, mortgages, auto loans, etc. 5. New credit, 10% of FICO score. Number of recent credit inquiries and new accounts. Why is a credit score important? A credit score affects your financial life in various ways. Loan approval. Lenders use credit scores to determine whether to approve a loan or credit card application. Interest rates. Higher credit scores can secure lower interest rates on loans and credit cards, saving you money over time. Rental applications. Landlords may check your credit score to assess your reliability as a tenant. Employment. Some employers check credit scores as part of the hiring process. How to check your credit score. You can check your credit score through several methods. Credit card statements. Many credit card companies provide free credit scores to their customers. Credit bureaus. Major credit bureaus, Equifax, Experian, and TransUnion, offer credit scores either for free or for a fee. Free credit score services. Websites like Credit Karma, Credit Sesame, and others provide free credit scores. Improving your credit score. To improve or maintain a good credit score, consider these tips. 1. Pay bills on time. Consistent on-time payments are crucial. 2. Reduce debt. Pay down existing debt and keep balances low on credit cards. 3. Limit new credit applications. Avoid opening too many new accounts in a short period. 4. Keep old accounts open. Length of credit. History is important, so keep older accounts active. 5. Monitor your credit report. Regularly check your credit report for errors or fraudulent activity. Common myths about credit scores. Checking your own credit lowers your score. Self-checks, known as soft inquiries, do not affect your score. Income affects your credit score. Your income is not considered in your credit score. It's based on your credit behavior. Closing credit cards improves your score. Closing a card can reduce your available credit and potentially increase your credit utilization ratio, negatively impacting your score. Understanding your credit score is essential for managing your financial health. By knowing how your score is calculated, why it matters, and how to improve it, you can take proactive steps to ensure you are creditworthy and can secure better financial opportunities. Regular monitoring and good credit habits will help you maintain a strong credit profile